Welcome, accounting boffins. You with Ashraf Patel and the crew. Today, we're revising cost accounting. Right, so what is it that we need to remember? We need to remember that some businesses, what do? They make products. That means they manufacture items, right? And then, obviously, the owner has to determine how much must he make, what price must he charge. All of that, then we use that information to determine the selling price of items, and also all of this forms part of what we call cost accounting. So we notice that businesses make products and sell. So this is what we call a manufacturing enterprise. Unlike a normal retail store that buys a product and resells it, this enterprise makes the product, manufactures it, and then sells that product. Keep that in mind. Manufacturing enterprises are different to trading enterprises because there are different costs to consider. Think about it. If you're selling furniture, basically what are you doing? You're just buying the furniture and reselling it. But if you're making furniture, then there are different cost components that you have to take into consideration with regards to the making of the product. It is therefore imperative for a manufacturing enterprise to do their costing accurately. Obviously, the costing has to be done to perfection almost. In order to do what? In order to arrive at the correct cost price. And therefore, also, once they have established the cost price, or calculated the cost price rather, then they can then arrive at the correct selling price. These costing processes are the focus of cost accounting. So in other words, the focus of cost accounting, if you hone into it, you will find that it is the costing of the product which is of paramount importance. So, if you look at the differences between a trading and a manufacturing concern, in a trading enterprise, obviously, it's your cost of sales, right? And your value of your trading inventory. But if you're looking at a manufacturing enterprise, all of that falls within the category of costing, right? So all of it falls within the costing. Then you have your cost of sales and your value of your inventory at the end. So at one point in time, you will find that your manufacturing enterprise then comes back where you have your sales and your cost of sales. Okay. So if we look at our mind map or our concept map, what do we find? We find that from our stock accounts, right? You will find that from your stock account, what happens? You move into your cost account, and from your cost account, you move into your work in process. Now, what goes into work in process is very important. It's your material, it's your labor, and obviously your factory overheads, and this is what we call our production cost. So, if we have to put this in a nutshell, we'll say that the costing process is made up of your direct material, which is your material cost, your direct labor, which is your labor cost, and obviously your factory overheads. These three components then make up the costing of the product. Now, what are the key words that we have to remember? One, direct raw material stock. What is this? This is the materials and components used in the production of an item. This is an asset account. The example would be your leather, your wood, your flour, depending on the type of enterprise. I've just given you a few examples. So this is the direct material that you are buying in order to produce the item that you are manufacturing. Okay? So once again, remember, all the items that go into the making of the product would fall under your materials. Then you have what we call our work in process stock account. Now, what is this account? This account shows the cost of raw materials, one, first component. Second component, it shows your labor, that's your direct labor. And thirdly, it shows you your factory overheads. Right. Now, obviously, the balance in this account reflects the cost of unfinished goods on hand. It's also an asset account. For example, let's illustrate by means of an example. If you walk into a factory at the beginning of the year, you will find some items in a semi-state of manufacture. That means not completely manufactured. Therefore, that would be your work in process at the beginning of your financial year. By the same token, at the end of the year, when you walk into a factory, you're going to find some goods that are at some stage of production, not totally manufactured, but in some state of manufacture. That would represent your work in process at the end of the year. Okay, so your leather that you've used, plus the salaries that you've paid to the shoemakers, plus the rent paid to the landlord. That's just a very simplistic example of what goes into the work in process. Now we come to a very important account, namely your finished goods stock account. This account indicates the production cost of finished goods that have been manufactured during the period, and this is also an asset account. For example, you've now produced goods. Those goods are what you call your finished goods. Those goods are now ready to be sold. Exactly. And this then means that if you're going to be selling, are you selling all your goods? Not necessarily. There may be some goods that you haven't sold as yet, and that would then be your finished goods. Example would be obviously the shoes that you've manufactured, or the cakes, or the furniture, or any product that you are manufacturing. So remember, the finished good is the finished item that is now ready to be sold. We now come to another important consideration, and this is what we refer to as indirect material or consumable store stock, right? Your costs of raw materials not directly related to the manufacturing of a particular product. This is also an asset account. Once again, think about it. The lubricants that you are using, or the cleaning materials, or the glue, they are involved in the making of the product, but they're not the main ingredient. For example, if you're manufacturing handbags, therefore, the leather would be your direct material cost, but the glue or what other component that you may be using in the making of that handbag would fall within the category of your indirect materials. They are there, but you can't see them. The glue, the stitching of the bag, etc. Right. When we come to finished goods, we now come to, we've done this one already. This is the one we come to now. Direct labor costs. When dealing with direct labor cost, this one is very, very important because very often you find accounting boffins out there get confused with this concept. So keep this in mind. All the costs or the salaries or the wages that are paid to those people who are directly involved in the manufacturing process, right? Your factory people that are in the manufacturing process, in the manufacturing of the product, the wages and salaries of those employees would be called direct labor. Okay, so the cost of employees directly involved in the manufacturing product. This is a cost account. So what is my cost account? Direct labor cost. Example of this would be your factory workers, the bakers, and the shoemakers. So think about it. Just think about this for a moment. A person who is cleaning the factory. Are they working in the factory? Yes, they are. Are they making the product? No, they're not. So would their salary be part of direct labor? Definitely not. Only those people who are directly involved in the making of the product. Okay? Keep that in mind. The next one we come to is indirect labor. Right? Okay, now, the cost of employees not directly involved in the manufacturing of the product. Let's take the same example that we had earlier on. The cleaner of the factory, the supervisor, the security personnel in the factory. Yes, they are working in the factory, correct, but they're not directly involved in the making of the product. Therefore, theirs is not direct wages or direct labor, but rather indirect labor. So, if you think about it, indirect labor would then be classified as a factory overhead. Okay? So keep this in mind. What are we saying? We are saying those employees that are working in the factory, correct. However, they're not involved, directly involved in the production of the item. They would fall under indirect labor, which would be a factory overhead. Okay, so now, if you come to the concept of factory overheads cost, all those costs which are associated with the manufacturing process but cannot be directly identified, this is a cost account. Okay? So in other words, think of all this, think of the situation now. Let's create the scenario for you. Within your factory, you've got the manufacturing of the product going on, right? But you have to pay for factory rent, right? You have to pay for factory water and electricity. You have to pay for insurance of the factory, right? And obviously, you have to pay the indirect labor of the people that are employed in the factory. You have to pay the rent expense of the factory. Notice, in every statement that I have made, what was the common word? The common word was factory. And that's where you identify the expense as being part of your factory overheads. Okay, so an easy way to remember this is if the cost has the word factory with it, it tells you that that would be part of your factory overheads. Clear? Right. So now, what are examples of this? We've mentioned the electricity of the factory. We've mentioned the insurance, depreciation, the rent, etc. Okay, so be very careful here, because if you are given the total rent of the premises, but you need the factory rent, therefore it would involve a calculation. But more about that a little later in our program. Okay, so now we come to a different concept, right? We talk about fixed costs. These costs are incurred irrespective of the number of products that are being produced, okay? So, obviously, when you're looking at your fixed costs, your rent expense, your water and electricity, all right? Within them, you're going to get fluctuations. But the umbrella, the overriding concept with regards to fixed costs are those costs that remain fixed, immaterial of the number of units that are being produced. Okay? Take, for example, your rent. If your rent is 1,000 Rand per month, or 10,000 Rand per month, or 50,000 Rand per month, whether you manufacture one item or whether you manufacture 1 million items, your rent will remain fixed. Therefore, we're saying it falls within the ambit of fixed costs. So, what do we remember? They remain fixed irrespective of the number of units produced. Then you get your production costs, are all those costs that are related to the production of the products, namely direct material, direct labor, and your factory overheads. Okay, we have now reached a situation where we have to complete a table. So clearly you can see from this table here, each of these have to be placed within a certain category, right? But what we're going to do, we're going to take a quick break. Keep in mind, we got an activity to do, so when you come back, we'll immediately start with the activity. See you just now. Welcome back, accounting boffins, right? Remember, we're busy with cost accounting, and we said, quick overview, our cost accounting tells us we have our stock accounts, where we move into our cost accounts, and then we move into work in process. Remember, the three most important categories of your work in process would be your materials, your labor, and obviously your factory overheads, and this would then give you your production cost. Okay, right, the activity that I promised you, here we go. Let's take the item and place it within the correct column where it needs to be. For example, indirect materials. Based on the activity that we've done, we know that that is a factory overhead, right? Advertising, clearly you know that that has to do with selling, so obviously it would be a selling and a distribution expense. Next one, direct labor. Now remember, there are two prime costs. In the manufacturing of any item, there are two prime costs. What are your prime costs? It's direct material plus direct labor. So therefore, your direct labor would be a prime cost. Okay? The next one, remember I said, look at the expense, but see what comes before it. Factory rent. That means that would be a factory overhead, right? The next expense says office stationery. So where was the stationery used? It was used in the office, therefore that would be an admin cost. Okay, so you must be able to place the cost in its relative component, and this will make it much easier for you to understand when you're doing the actual ledger accounts and related information. Okay, so now we move on to our question. It says here, Julius Mamba manufactures handbags. He works at home using his father's garage. He's only able to produce 40 handbags per month. Okay, that's our information. We are expected to calculate the total fixed cost, the total variable cost, right? The selling price at the break-even point. Okay, and then obviously, will Julius be satisfied with the selling price? So, before we actually go into the question, let's first make sure we understand what we mean by fixed cost and variable cost. Right, firstly, fixed costs are all those costs that remain constant irrespective of the number of units that are produced, right? Now, if you take your 5 cost components, break them up into the 2 categories, right? So we have fixed costs would be your factory overheads plus your admin costs. Think about it. The people that are working in the admin section, immaterial of how many units you produce, you still have to pay the secretary the wages at the end of the month. So those 2 costs, namely your factory overheads and your admin costs, would fall within the category of your fixed cost. Right. Then the other 3 cost accounts, what are they? It's direct labor plus direct materials, okay, and your selling and distribution costs. Those 3 costs will vary with the levels of production. In other words, the more you produce, the more labor you need. The more you produce, the more materials you need. The less you produce, the less selling and distribution expenses there will be. So clearly you can see that these three cost accounts would fall within the category of variable costs. Once again, fixed costs do not change with the number of units that are being produced. Or in other words, variable costs vary with the number of units that are being produced. Clear? Okay, so now we have understood the concept of fixed cost and variable cost. Okay, so the question now says, these are the average monthly expenses, material and other components, direct labor, rent for the use of the garage, water and electricity, which 60% is your variable, indirect materials used, sundry expenses in the manufacturing process. So these are just your information on which the question will be based. Okay, now we are asked to work out the total fixed cost. So this is what we do. Firstly, let's identify our fixed cost. Okay? So immediately you go in and say, fine, we're looking at fixed cost, which would mean it would be my water and electricity, right? 775, however, they're telling you 60% of it is your variable. So immediately you go here and you say 775 times the 40%. So obviously, let's do that calculation. We've got 775 times the 40% will give me a figure of 310. So that's my 310 there, right? So going back, let's find the next item that we need. Remember, we're working with fixed costs, okay? So you have to look for the information to determine what are your fixed costs. Okay, so the next item we find there is our 1,250. Clearly you can see your rent, because it falls within the ambit of your factory overheads. Obviously, that would be your fixed cost. So clearly, the rent of 1,250 is the next component. So that's your rent. Okay. This one was your water and electricity. Right. The next item that we look for is to see what else are we told. We are told indirect materials used in the manufacturing process works out to 460. Let's see, there's my 460 there, right? And then I can see the next item that I need there will be my sundry expenses in the manufacturing process, which will be my 200. Let's go back. Here we go. There we are. So all these components would be, remember this 310 is obviously the calculation of that bracket. So if you add 1,250 plus the 310 plus the 460 plus your 200, you will get a figure of 2,220. So your total fixed cost, can you see in this particular question, you had to identify your fixed costs. Remembering that fixed cost has two components. What are they? It's your factory overheads and your admin cost. Okay. Now that we have our total fixed cost, the next item we need to calculate is our total variable cost. Okay, once again, looking at our information, we know that variable cost would be direct material, direct labor, and my selling and distribution cost. Okay, so here we go. Look at your direct labor. You can clearly see here that you got the 555, which is your labor, okay? And you also have your, so there's the 555, we bring it in. The next item that we look at is materials for the components was 520. So again, you bring in the materials at 520. Let's do that. There's the materials. So let's just label it, making our task a bit easier. Our material was 520, so therefore 520 would be material. The 555 was your labor. There we go. Your labor was 555, so that's your labor, right? And then you were also told that, and this is important, you were also told that in your water and electricity, 60% was the variable component. Okay, so obviously in this activity here, notice that the examiner wants to see whether you can separate your fixed and your variable. So your variable, if that was 60%, obviously it would be your 775 times your 60%. Okay, let's do that. It would be 775 times 60%, and this will give me a figure of 465, right? So here we go, that would be 465. Okay, so if you now add 520 plus 555 plus your 465, it's going to give you a total variable cost of 1,540. Okay, so you can clearly see you must be able to identify the items in order to be able to calculate your fixed cost and your variable cost. Now we come to a very important concept of break even, right? What do we mean when we say break even? Watch. It is the number of units that must be produced and sold to cover the total cost, where obviously your incomes will be equal to your expenses. In other words, you're not making a profit or a loss. So the total number of units that you have to produce and sell in order to break even. So at the break even point, your incomes are equal to your expenses, right? They are equal. That means no profit is being made and no loss is being made. But the moment you produce more than the break-even point, obviously you're now making a profit. And if you produce less than the break-even point, obviously you're then going to make a loss. So the break-even point is a very, very important indicator for a manufacturing concern. It gives them a clear indication of the number of units that have to be produced in order to break even. And this is the point where they will neither be making a profit or loss on the process if at the break-even point. So if the break-even point is, for example, 5,000 units, at the point of production of 5,000 units, the business will neither be making a profit or a loss. Okay. Then it shows you the level of sales that is required. It assists with determining the markup, percentages, and in assessing whether the production of this product is a viable venture or not. Obviously, this will give you a clear indication whether it is viable to continue making the product. And that will then inform you as to what your markups have to be, what your percentage, when you do those other financial indicators, when you're working out your percentage markups, you would see it would tie in with this here. So we have the information again of Julius Mamba, and the question said now, the selling price at the break-even point. Okay, what have we done so far? We've calculated the total fixed cost to be 2,220. We've calculated our variable costs for the 40 bags to be 1,540. Okay, what are we going to do now? The question says, what will be the selling price at the break-even point? Notice a twist or a challenge in this question. You normally ask to calculate the break-even point. What is the calculation for the break-even point? It is your total fixed cost in rands over your contribution per unit. What is your contribution per unit? Selling price per unit minus your variable cost per unit. Please, guys, it is important, it is imperative. You have to know this indicator before you attempt to actually answer it, right? So what is it? Once again, it is your total fixed cost in rands divided by your contribution per unit. And what is your contribution per unit? Selling price per unit minus your variable cost per unit. Okay, this means therefore, there we go. Our variable cost per unit would be the 1,540 divided by the number of units, which is your 38 Rand and 50 cents. So there's my total fixed cost, 2,220, over selling price per unit minus your variable cost per unit. Remember? And we also know that the total number of units that we have produced is 40. So there we go. You take the 2,220 plus the 1,540 divided by the number of 40, which obviously is your number of units that you produced, and it gave you a figure of 94 Rand, being your selling price per unit. Okay, so this is how you calculated your selling price per unit. So in the entire calculation, your selling price per unit was your unknown. Clear? And because you were then solving for X, which was your unknown, you came up to a figure of 94 Rand. So, will Julius be satisfied with the selling price? The answer obviously is no. He will not be satisfied with 94 Rand per bag because he will not be making a profit. He'll only cover his costs. So understand this, that at the break-even point, you're not making a profit, neither are you making a loss. Would you be satisfied with that? Certainly not. Right? He must assess the market and competitors to determine if he would be able to sell these bags at a higher price in order to show some profit. So if he continues to sell at 94 Rand, all that he's doing is he's breaking even, meaning no profit, no loss. So all the efforts for nothing? Definitely not. So he needs to assess to increase that selling price so that definitely we could then be making a profit. Okay guys, that's the end of this segment. Let's take a quick break, let's refresh, and when you come back, we start with the last segment for today's show. See you just now. Welcome back, accounting boffins. Right, a quick recap of our cost accounting section. Remember, when we're looking at cost accounting, we said the flow of information from my stock account into my cost account and there into my work in progress. Again, remember, sometimes you see the word progress and process. It's the same account, it's used interchangeably. Right. If you take your cost components, remember once again, let's take the two cost components and break them up into one. Your fixed cost would now be your factory overheads and your admin cost. Then you have your variable cost. What are your variable costs? Those that vary with the levels of production, and that would now be your direct material, your direct labor, and your selling and distribution. So those are your two categories of cost. But when you're looking at production, then it is three cost accounts, namely direct material, direct labor, and factory overheads. That gives you your production cost. Okay, so don't assume or don't take for granted that because it's a variable, it will not impact on my cost accounting. No, know that the cost of the product has three components: material, labor, and selling and distribution. Okay, let's repeat that. The cost of the component has material, labor, and factory overheads. Keep that in mind, right? Okay, so we now move on to the information that we have here. The School's Choice Factory Shop has Mary as the owner of this business, which produces and sells school uniforms. The information given relates to the pairs of trousers that her factory is producing, amongst other items of the school uniform. Okay, this is the information we have at the beginning of the year, There's your opening balance, right? There's your closing balance. Very important when you are working with a table, please make sure you know the direction of your arrow, right? And I keep on telling learners this just to make them some kind of concept. If your arrow or your love arrow is misdirected, it creates havoc in your lives. By the same way, if your accounting arrow is misdirected, it creates havoc in your accounting calculations. So make sure the arrow is in the right direction. Okay. So there's our information: raw material stock, work in progress, finished goods, and indirect material. There's the information of all the transactions that we've entered into. We are expected to calculate, firstly, the indirect material cost. Right. So this is what we do. Step number 1, identify your indirect material at the beginning of the year. Right? So here we go. Where's my indirect material? There we go. Beginning of the year, we had indirect material on hand to the value of 5,500. So here we go. Here's my calculation. There you see it. 5,500 is my starting of my calculation. Then, how much raw material or how much indirect material, did I buy this year? So we go and check in my information, how much of indirect material did I purchase? Purchase of indirect materials, 46,000. Bring that in. That's the next component there, 46,000. Right. So that's the procedure. You always start off with your stock of indirect materials, then bring in your purchase. No information was given to you about any returns of indirect materials. However, you are also told now that 3/4 of the indirect materials were used in the factory. So not all the indirect materials was used in the factory. Only 3/4 were used in the factory. Therefore, this is what we do. Watch. You take that. That's the 3/4 component. However, another important consideration. Did we use up all the indirect materials? Watch. This was my opening balance, but I have a closing balance of 11,000, meaning those indirect materials were not used. Okay. Remember, guys, we're dealing with indirect materials. Right, now, in my calculation, watch, that's my opening balance of indirect materials. That's my purchase of indirect materials minus what is left over at the end of the year. That means these indirect materials, as you can clearly see, were not used. That's a stock figure. Therefore, 5,500 plus 46,000 minus 11,000. Let's do that calculation. Here we go. 5,500 plus 46,000 plus 11,000 is equal to all the materials that you had available on hand. Sorry, there's an error in my calculation. Let's go back. Let's cancel it. Can you see? Watch my operations. Important. 5,500 plus 46,000 minus, it's the end of year balance, 11,000, to give you a figure of 40,500 times 3 divided by 4 will tell you that you used 30,375 was the indirect materials relative to the factory. Right. Now, the question doesn't ask for it, but the other quarter will then be apportioned to either my selling and distribution or my admin, wherever the indirect materials were used. Okay? So you can clearly see the entire indirect materials has to be apportioned to, in this case, factory overheads or direct materials or in your selling and distribution. Let me repeat that. Your indirect materials has to be apportioned to either your factory overhead cost component or your selling and distribution cost component or your admin cost component. Right. Okay. The next one we have here is we have to calculate the maintenance account was debited in error with a payment of 10,000 Rand for the telephone. 80% of the maintenance relates to the factory. Calculate the maintenance cost as it is applicable to the factory. So here we go. You start off with your 45,000. Where does it come from? My figure that's given to me was the 45,000 Rand for maintenance. However, there was an error there of 10,000 being debited to the maintenance incorrectly. So minus the 10,000, clearly you can see 45,000 minus the 10,000, obviously this will give you 35,000, right? And only 80% of the maintenance is applicable to the factory. Therefore, what do we do now? We multiply that figure. So let's do that. Here we go. We have 35,000 Rand. You can see it is the 45 minus the 10 times 80%, which is applicable to the factory, will give you a figure of 28,000 Rand. There's your 28,000 Rand, which is the maintenance which is applicable to the factory. Right. Next one. Again, our information, but now it says here, rent expense includes rent for March 2020. The rent was increased by 768 per month as from the 1st of October 2019. Rent is proportionally allocated to the various departments according to the space occupied. Right. Now, two parts to this question. Firstly, your rent figure needs to be adjusted. Let's do that. What are we going to do? Let's take our rent figure, which is 129,408. Here we are. And we say, take the 129,408, right? Now, let's first subtract the increase portion. Remember, the increase in your rental was, let's get the information. Here we go. The increase in the rental was 768 per month from October to, and rent included was, the March figure was included. So in other words, your rent increased in October. October, November, December, January, February, including March, because you've got the rent for March in there as well. So it's 6 months, right? So step number one, take the 129,408 minus your 768, remember, times 6 will give you a figure of, now what have I done here? I'm subtracting 768, which was the increase for 6 months. So 768 times the 6, if you subtract that, now you have your rental, all of them on the old rental, right? Now, divide that by 13. Why 13? Because your March figure is included in that rent component. So, once you divide it by 13, you get an answer of, where was the error? Let's go back again. It was 129,408. Let's just check that figure. 129,408 is correct. Okay. So we got 129,408 was the given figure, minus the 768 times the 6 will give you 124,800. Divide that by 13. I explained why the 13 months. So in other words, your old rental was 9,600 prior to the increase. Okay, plus add the 768 will give you a figure of 10368. So watch here. This is what we're doing now. There we go, 129,408, 10,368. So if we look at this figure once again, it was a 129,408, right? And we then removed what? The increase of 768 by 6 months, okay? And then obviously we then divided that figure by 13. Eventually we came to the answer of 10,368. So take the 129,408 minus the 10,368. Okay, now the second part of the question. Now you are told that the factory uses 600 squares, the admin 250 squares, and the sales department 150 squares. The easiest way to do this, guys, is add your total factory space. That is 600 plus 250 plus 150, right? That will give you 250, 3, 4, 1,000 squares, I think. It should be 1,000 squares. Let's go and check our calculation now. Right, there we go. It's your 129,408 given figure. Firstly, subtract the adjustment for March, which is not part of the financial year. Then you multiply it by factory space was 600 squares over the total square meterage of the entire premises, right? Therefore, important, break up your components into factory, admin, selling, and distribution. And in this way, once you have broken it up, you can see the factory is using 600 squares of the 1,000, and then obviously your calculation. Here's our calculation. We have, let's take the figure, 129,408, right, minus 10368, which was the rent figure which we're removing, gave me that figure there, times 600 divided by 1,000, and let me just delete that, 1,000, and that will give you a figure of 71,424. That will be your rent expense for the factory. So what was important in this calculation? Number one, there was an adjustment that you had to take into consideration, right? So you've done the adjustment because the rent was paid in advance. You subtracted that figure. Obviously, this was a prepaid expense. Can you see how your knowledge of adjustments will also be needed when you are doing cost accounting? Then obviously you have to work out the rental and apportion it in terms of the floor space. Important, use this technique, add the floor space of the entire premises and then take the factory over the total. Okay, the next one that we have to do is we are told that we have 5 casual workers who clean the factory at 45 Rand per hour. They each worked 192 hours of normal time. 2 of them worked 40 hours and each of them has an overhead rate of 50%. Watch my calculation here. Your 5 at 45 at 192, that's normal, right? The 2 who worked extra 40 hours times obviously the increased rate, you will see that here they told you that 2 of them worked 40 hours at overtime at a normal rate plus 50%. So obviously you can see that they are working and getting a figure. Obviously your overtime rate is higher than your normal rate. Okay? So that was your calculation of your indirect wages. The last one that we have to do here is, okay, we've got all that information right. Oh yes, this is what we have you to do here. Now obviously, what you now do is you add your total factory overheads. Which items? Remember, it is your adjusted items. Okay? So now, if you were asked to show this in an exam as a calculation, I appeal to you, I beg you, make sure that you show your calculations in brackets. Remember the calculations that we've done as standalone? If you were doing this as part of an exam question, show your calculations in brackets, because perchance, if you make an error, you will get a part mark. You then add your total factory overheads to give you a figure of 607,579, and that would then be the total factory overheads applicable to this factory. Okay guys, we've done a lot of work in today's lesson. We want you to make sure that you understand this section on cost accounting, because remember, it is definitely examinable, and once you get to grips with it, I promise you, it will be a section which you will love to do, and you will score full marks in this section. Until the next time, we're going to reach for the moon, and perchance if we don't get there, we're going to be a shining star, an accounting shining star. From me, Ashraf Patel, and the team, until the next time, be good. Goodbye.